Economics at New School of University in New York, Professor Deepak Nair and Professor Jayati Ghosh, both of them in JNU Economics Department. We'll begin the session with Professor Anwar Shaikh. It's half an hour for each speaker before we have a tea break.
The talk I'm about to give is based on a recent paper of the same name, The First Great Depression of the 21st Century, Causes and Implications, which appeared in Socialist Register 2011, so it's a recent copy. Also, some of the things I referred to will be on my home page, and you can find my home page by just typing in my name with the word economist after that to distinguish me from other people with my name. And you'll be able to see almost everything that I refer to there. Let me begin by saying that I want to make a specific argument here, and that argument is that the current crisis that we're seeing is part of an age-old recurrent pattern, age-old and recurrent only within capitalism, because there's an expression of what Marx calls the laws of motion of capitalism, or what Ricardo called the laws of political economy, and what Smith called the invisible hand. I'm going to try to make some reference to the principles involved, but obviously this is a big topic, and I will not be able to get to it most likely within half an hour time limit, or within the 40-minute effective time limit, judging from experience. And one of the regrets I will have is not being able to show you my data on recurrence, which is on long waves, and the precise way in which Great Depressions, crises occur in certain phases of the long wave, including the crisis in the 1970s and the present crisis. I have been frightening my graduate students with the potential for a new crisis since 2000, because my long wave indicators turned down so nicely. And it has now come, and they are terrified, rightfully so. So I want to first get out of the way the notion that the mortgage crisis in the United States was the cause of the present crisis. It was a trigger, not the cause. The immediate cause was the huge credit bubble which preceded it for decades, which included within it the technology bubble, the dot-com bubble, so-called. And the main factor in there was an extraordinary decline in the interest rate. I'm going to come to that, which permitted a huge borrowing by consumers and a real estate bubble on a world scale. So it's important to see that these patterns were on a world scale. And of course, in fact, most capitalist countries, the creation of new unregulated financial instruments and the deregulation of existing financial activities, which was all done under pressure from the capitalist class itself. It wasn't that workers were pushing for investment banks to be able to create CDOs and asset default swaps. It all came from financial capital, and indeed from capital in general. And the reason is simple, because they saw potential for great profitability there. So the question that leads us to is, why is there a credit bubble in the first place? Was it just the folly of some central banker in the United States, such as Alan Greenspan? I would argue not. I would argue that we're experiencing a structural crisis, part of a recurrent pattern. And indeed, the pattern I'm speaking to is something that has been called in economic history, and particularly in business cycle history, a Great Depression. And I will show you some data on that shortly. 1840s, the 1880s, the 1930s, which we now call the Great Depression, the 1970s, which we call the Great Stagflation, and now the present period again beginning in 2008. What is interesting is that some of these Great Depressions were off the cliff. That is to say, the whole financial system collapsed and it dragged the economy down sharply. 1848 and 1930 was of that type. The others were long, protracted declines in the 1880s, the Great Depression of the 1870 to 1893 period, and the 1970s, the Great Stagflation, were of that type. Now, I believe that we've entered a Great Depression now, not because of failed policies, but because this is the characteristic pattern of a dynamic, successful capitalist economy. It overshoots for long periods of time, that overshoot is covered up, and then it comes crashing down. First point, is to understand that if we want to analyze capitalism, we really need to understand the importance, the dominance of the profit motive. Often one hears in economics, especially on the left, that the thing that drives capitalism is effective demand. I would argue, and this is not just my argument, it happens to be also the argument of the business sector, that capitalist enterprises are not driven by sales, but by profit. As Business Week says, sales without profits are meaningless. Well, of course that's correct. If I offered you $10 million for something at something below its cost, you wouldn't bother because you wouldn't make any money. It's the difference between the cost and the selling price that motivates capital. And from this point of view, demand is effective when it is profitable. And that's something that's gotten lost in the discussions of effective demand. In any case, it is an old argument in the classical tradition, and this is true in Smith, Ricardo, and Marx, as well as in Keynes, by the way, that capitalism is driven by the net profit rate, what Marx calls profit rate of enterprise. Now, the profit rate on the surface is a fairly straightforward thing. You put investment in, and you get your investment back and some extra money, and that extra money is your profit. Anybody who's dabbled in any kind of financial instruments knows that you have to come out with more than when you started, otherwise you don't make profit. So the profit rate is the ratio of the profit to the amount of investment, the amount of capital that you've tied up, and that's a traditional measure. And that's important because it is, as Marx puts it, the raison d'etre of capital itself. Without it, you have failed. It's not enough to get back your money, you must get back more. Every business will tell you the same thing. The interest rate, on the other hand, is the opportunity cost of capital. It is the return that you get for not taking that risk of throwing money out into the uncertain stratosphere and hoping that it'll come back. And therefore, it is a kind of passive return, and that again is a description in many economists. So what matters is the degree to which your rate of return, your profit, is bigger than this passive return, which is your interest rate. Again, it's easy to show in Smith and Marx and Ricardo and Keynes and many, many others, even in the neoclassical tradition, talk about this as the driver of accumulation. This is the difference between the profit rate and the interest rate, which Marx calls the profit rate of enterprise. It is the rate of return to enterprise. There's a second argument which I'm going to skip a little bit, which is that profitability has an impact on the amount of profit, and it's when the amount of profit net of interest, the profit of enterprise, adjusted for inflation, begins to stagnate that the system is in trouble. And the logic of it is something that is being developed more explicitly. It's in phrases here and there in Marx, but it's developed more explicitly in the arguments by Henrik Grossman about how profitability affects accumulation and where the moment is that accumulation becomes threatened and weak. So in this argument, the massive real profit of enterprise, when it begins to stagnate and flutter, that is a point in the system where you are investing, but you're not getting back any more than what you put in because the amount of profit is not growing, so that though you're adding capital, you're not adding profit, and that means some capitals at least are not making money, and more likely a whole set are losing money. This triggers a phase change in the behavior of the system, and the long boom, which accompanies accumulation, turns into a long downturn. And as the downturn builds up, all kinds of problems have been covered up by the great boom become uncovered, and there you enter the period where crises tend to occur. Warren Buffett, who knows something about long booms and how to take advantage of them on the up and the down side, those of us who have a lot to learn from that, says that you only learn who's been swimming naked when the tide goes out. Well, the tide has gone out, and we see a lot of people have been swimming naked. I'm using the term crisis in a specific sense, in the sense of Great Depression, and that is not the same sense as the sense of a business cycle. Business cycles are absolutely normal. Leo Panitch mentioned today Marx's own anticipations of a crisis in 1857. But if you read through Marx's analysis of crises as his own ideas develop, you see that he began to recognize that what was called the crisis, which was a business cycle in modern terminology, was something very different from something called the Great Depression. And the 1840s was a Great Depression, but 1857 was a local financial crisis, which did spread through but rapidly recovered. So it's important to understand that distinction. So let me first show you. I apologize for doing PowerPoint, but there's really no way to describe broad patterns in capitalism by waving your hands up and down in the air and jumping up and down. So I have to do it this way. This is a picture of U.S. industrial production since 1860, from 1860 to 2004. And what you see, what I see when I see it, is two things. One is that capitalism is inherently dynamic and expansionary. And we can do this for any advanced country, and you will see that. Not true for all capitalist countries or all capitalist eras, but the successful countries, center countries, the dominant countries always have this pattern. And the second is that you see that there are lots of fluctuations. And those fluctuations reflect the fact that expansion is not steady. It is turbulent. So this is one of the important points to understand turbulence. Here's a picture from a wonderful book by a man named Leonard Ayres called Turning Points of Business in Business Cycles. It's cited in that Socialist Register paper. And you can see that the parts below the horizontal line are positive parts of the cycle, and the parts below are the downturns. And what you can see very clearly is that cycles are totally normal. Every business knows this. Every historian of economics knows it. And so we call every upturn a boom and every downturn a crisis. We're conflating the normal part, which is this fluctuation, with that part there, which you can see. I don't have a laser pointer, so you have to imagine that I have a laser pointer. You can see that in the 1840s, the business historians call that period the Great Depression. That was the term used in the literature. You see the effects of wars, which are generally good for winning countries, but not for the losing side. And you can see the recurrence of these cycles. So this period here covered in the graph is 1831 to 1862. Well, things don't change very much in that next period, which is a similar time span, 1867 to 1902. You see the ups and downs, and there, right in that beginning again, you see that phrase, Great Depression. Only now we're talking about the 1870s rather than the 1840s. And then again, 1903 to 1939, and you see these ups and downs, they're not regular in the sense they're precisely the same, but they're recurrent in the sense that they keep coming back. And so the notion of recurrence is a very important aspect of my argument. You see the effect of World War I, both the up and the down effect after the end of the war, and again this great red period at the end, which is of course called in the business literature and in economic literature the Great Depression. One of the great, John Kenneth Galbraith says that when he's looking at the Great Depression, he says, will it happen again? And he says, I hope not, but most likely, because these things recur as soon as people forget what happened in the last one. And we are made to forget. It's not that we accidentally forget. That memory is obliterated. So, how do these relate to the path to the current depression? First point, accumulation is driven by profitability. The second point in the argument, which I can only assert, but I have written about elsewhere on crisis theory, and it's on my homepage, is that accumulation undermines profitability. So not only does profitability drive accumulation, accumulation drives profitability in the opposite direction. The rate of profit falls. The stagflation crisis of the 1970s and 80s across the whole capitalist world was a Great Depression. And in fact, there are articles from that period, which I still have, since I'm old enough to have been practicing as an economist then, in which Business Week and Wall Street Journal is saying, is this, in quotation marks, it? They won't dare say the name, but they meant, of course, was this the Great Depression. Well, it was covered up, we know. It was a big, widespread bank failures, business failures, sharp rise in unemployment, not different than now, but covered up by rampant inflation in the whole capitalist world. And that was an important means of covering that. because it led to a decline in real wages and concentration and centralization of capital at the same time that everything seems to be going up in prices. Well, the recovery from this Great Depression, which was a great stagflation of the 1970s, was driven by something quite extraordinary. And every depression has its own recovery mechanisms, which are in some sense local and conjunctural, even though they are playing out of different possibilities of recovery. First of all, an extraordinary global fall in the interest rate, which raised the net profit rate and fueled a recovery of accumulation. You can see the net profit rate is the difference between the profit rate and the interest rate. Well, if I can lower the interest rate, I automatically give a great boost to accumulation. Secondly, an historical attack on unions, on the welfare state, and on the standard living of workers in the center, especially in the US and UK. And thirdly, this lowered interest rate combined with this attack, of course, led to a great recourse to debt to cover up the decline in the standard living of workers, whose standard living actually went down, whose objective basis is standard living. The real wage went down, but their standard living stayed the same or growing. The difference was debt. They covered it up by rising debt, which was pushed upon them, of course, by offers from financial capital. So now we come to the key point. First of all, what does the first part of the driver accumulation look like? All data that I'm talking about comes from the US BEA, Bureau of Economic Analysis, or related agencies, and the details and methods are in my paper. And you can see that you have this great period beginning in 1947, declining profit rate, then the great jump up caused by the Vietnam War. I don't know if everybody can see that, but that's in the early 1960s. You see the big jump in the profit rate, and then the fall again, because those jumps have a temporary impact, and a return back to the trend of the falling profit rate. And then what you see, so the middle part there, which is the sort of purple area, is the crisis, the great stagflation of the 1970s. And then you see this green part, green for capital, by the way, not necessarily green for people or the environment, but I'm taking the point of view of capital in this whole talk, at least near the end. And you see that here something quite distinctive happens. There is no rise in the profit rate. Typically, a recovery of a depression is a rise in the profit rate. But this time, the profit rate is essentially stagnant. And that in itself is quite extraordinary. If you see now the second part of the argument, which is the interest rate, you can see that the interest rate rose all the way up in the post-war period until it peaks around 1982. And there is a little jump up there, which I've highlighted with in the center with the darker pink period, which is a so-called Volcker shock. People often talk about the Volcker shock as if it ran the whole interest rate show. But if you step back and look, you can see interest rates were rising steadily. And that is because prices were rising. There is an intrinsic connection and a theoretical connection, which I obviously cannot elaborate on here, between the interest rate and the level of prices. Not the rate of change of prices, as in standard economics, but the level of prices. In any case, the green period for capital is a period of an enormous decline in the interest rate. And that is quite striking. It's quite unusual in the sense that it's really historically unprecedented. So the boom is attended by a long fall in the interest rate. And it's not just the US interest rate. This is a graph in which the solid line is the US interest rate, which we've already seen, and the dotted line is the interest rate of US trading partners, which is pretty much everybody of importance in the capitalist world. And you can see that these two patterns are very similar. Now this raises an interesting question. What is it that caused interest rates to all rise and fall together? One answer is that there's a room somewhere in, it used to be the World Trade Center, but it's somewhere in the US where people sit around and tell the capitalist world how to set interest rates. That's one theory. I obviously don't share that theory. I would argue that much of this run up and run down was due to intrinsic relations between interest rates and prices and accumulation. But in any case, I cannot develop that. What is interesting here is to note that there is a parallel movement in all the major countries of the world, with some differences, but you can see the similarity in the pattern. So that brings us to the key variable, which is the difference between the interest rate and the profit rate. And now you see very clearly a long fall in the profit rate of enterprise, beginning in the post-war period, and falling all the way down to 1982, which is the end of the great crisis of stagflation. And then you see that that profit rate of enterprise rose. We saw earlier that the profit rate didn't rise, but the interest rate fell, so the difference between them rose, and that was the fuel for the great boom of the 1980s up to 2008. Now that boom not only fueled, I'm going to skip some things here, not only fueled accumulation by making the profit rate of enterprise rise, it fueled the growth of consumer credit because cheap interest rates made it possible for consumers to borrow without spending more money. Every time the interest rate fell, they could borrow more, and still the net debt burden, I'm going to show you that in a minute, didn't change. And of course it fueled the rise of global capital and financial capital, because capital is so cheap it made it possible for it to literally sweep across the world. So that's the first thing that caused the great recovery, the fall in the interest rate. But the second thing was a quite dramatic change in the relation between wages and productivity. To use an old term, a quite dramatic change in the pattern of the rate of exploitation of labor. The dark line that you're looking at there on the graph is the hourly compensation of workers, and the dotted line is the hourly productivity. Both are indexed to 100 in 1982, so their level doesn't mean anything, but their trend means something. And you can see that real wages and productivity rose more or less hand in hand from 1947 to 1982. A little bit of a change in the crisis of the 1970s and 80s, but you can see this parallel movement. And this is why often some economists refer to this period from the point of view of labor as the golden age, where there's a structural balance between capital and labor, and the wages were linked to productivity. Well, that changed with the advent of Reagan and Thatcher and successive governments across Europe which followed those policies. And you can see now in that period of the boom, the second great factor causing the boom, which is the great rise, the continued rise in productivity, but the fall off in the real wage. So that now in this period we have real wages falling relative to productivity. They're still rising, but productivity is rising faster, and real wages are rising more slowly. And that difference, of course, is an enormous factor in raising the profitability of capital. In my paper, I separate these into two different components to show you the impact of the interest rate and the impact of this profitability. But basically, you can say that had this second movement to the rise in the rate of exploitation not taken place, the rate of profit would not have recovered, the rate of profit of enterprise, and you wouldn't have had the boom. Some quick reference to other things, which is the U.S. debt-to-income ratio of households. You can see that beginning in 1950s, this rises. Then in the Great Crisis, it's more or less stagnant. But then in the recovery, you see this enormous rise in the debt-to-income ratio of households, which is, of course, how households were coping with the fact that their real wages were slowing down. They maintained their standard of living by going into debt. And we know that that debt reached a limit, a peak, in the 2006-07 period, and then has now come down. One reason this was possible is that as interest rates fell, the debt service ratio, the amount of money you pay every month on your debt, was able to rose much more slowly, because interest rates fell, you could borrow more money and still maintain a more or less stable ratio. And that held until about 2000, when the debt ratio began to rise sharply, the debt service ratio began to rise sharply for households. So let me stop for a moment. I have 7 minutes. Do I have 5 minutes? Okay, I might be a little bit over, but I think I can make it. Yeah. Okay, thank you. Yes, if I want to, I want to be in Indian time, right? I'm arguing on left time, actually. I'm arguing that the recurrence of the Great Depression is an intrinsic outcome. It's modified in its path and expression by conjunctural factors, and this related to the presentations early this morning by Perry Anderson and Leo Panich. But in my opinion, it is not determined by conjunctural constellations, but in fact driven by the fact that profitability has its own dynamic. In that sense, it is intrinsic to capitalism itself rather than to a particular moment and episode in capitalist history. The second point, which is important to make, is that Great Depressions have built-in recovery mechanisms. The lowering of the real wage relative to productivity, which I was just showing you back there, is a recovery mechanism. It's a mechanism by which the profit rate is raised. The lowering of the interest rate, that's a recovery mechanism that is in the hands of capital in some sense, if, of course, they're able to impose it on others. And, of course, there is the concentration and centralization of capital, that is the buying up of weaker capitals by stronger ones, often with money lent to them either by banks or by the state more recently in order to consolidate their power. And the most important thing now is that this is done truly on a global scale. It is not a local phenomena. It is a global phenomena. Both the reserve army of labor and the effect of that on real wages, that's global, and so is concentration and centralization. I believe that shifts in the hegemonic balance of power will not change this intrinsic dynamic. It will change the expression of it. It'll change the occupiers of the throne, but it will not change the fact that there is a throne, and thrones have their own internal logic. I realize that puts me in a vanishingly small minority, but I'm used to that. I want to end by talking about a thing which is very important, and if I have time, maybe about long waves, which is that it's often made the point that recovery from Great Depressions can be brought about through wars. I'm going to skip the data that I have about the Great Depression because that's in my paper, but I want to make the general point. Yes, wars can aid in recoveries, but that is because wars allow two kinds of things: huge expansion of the state on deficit spending and the repression of labor reactions to that, focus on rebuilding the nation, on eliminating poverty. And the discussion earlier about Brazil was an important point about that different forms of mobilization can take place. In the environment is another possibility. So I'm going to skip the argument I want to make, which is that the Great Depression was not, in the United States, was not recovered by the war, but in fact was recovering well before the war. So if I skip that with your permission, I can come back to that. Recoveries, social mobilizations have two forms. And you can see that even in the Great Depression in the United States. One is what I call the trickle-down effect. You throw large sums of money at capital, and some of it may slip down if they're inclined. So some of it may wash upon people at the bottom. But that generally doesn't work in a Great Depression for the simple reason that if you give money to businesses or you give money to financial capital, they quite sensibly want to hold on to it because they have assets which are worthless, and this enhances the liquidity. But more importantly, even if they are very liquid, like many banks are, some strong banks, why the hell would they want to lend it to people who have no prospect of paying it back? In a depression, prospects are very dim, they're very short term, and so loans are risky, and banks understand it and are acting perfectly rationally and sensibly. They get large sums of money from the state and they keep it. General Motors gets large sums of money from the state and they keep it. Well, of course they keep it because there's no point in throwing it out if they don't expect to come back with a sufficient return. But the other mode, which is also took place in the Great Depression in the United States at least, but also in England and in Germany in a different way, and Italy, is the employment of labor directly. Wars do that. They employ people directly, but so does social construction. Roosevelt's WPA, the Work Projects Administration, did enormous amounts of work in the country in which they paid people, from everything to rebuilding dams and roads to recording music and literature and so on. And that is a direct form. Naturally, that is not a form that capital is particularly enthusiastic about, because that form, the money spent on people directly to employ them to do socially useful things, trickles up to capital. To the extent that they spend that money, there's business demand for it, and some of that may create profits for capital. Whereas the money given from the top goes first to capital and trickles down only, perhaps, to people in need. Now, I could not resist, Boris Kargaliski brought up a very important point about long waves, and I want to just make this point, even though it may not seem related to what I'm talking about, but it's a point about recurrence. The picture I'm showing you now are prices and in the United States and the UK from 1790 to 1940. The price level in national currency. These are index numbers, of course, but they're in British pounds and American dollars. And you can see these waves in these prices, and these are the waves that Kondratiev was looking at, looking further back earlier, but include a good part of the Kondratiev wave. And you can see these waves, and I'm going to come back in a minute to the relation between these waves and cycles and crises. But you can see visually a clear set of patterns of long waves, and that's what gave the idea to Kondratiev that price long waves are a signal of some underlying rhythm. Now, it is a very sad thing for Kondratiev, in my opinion, that he made a choice of how to display this data. What he did was he had two sets of data in which the prices are in national currency, and in the back of his book, in the appendix, he has data in which prices are expressed, all prices of each country is expressed in a common currency, and that common currency is gold. Had he done the second one, you will see that he would be the prophet of capitalism, because those long waves continue to the present. But he did the first one, which is the local currency. And look what happens when you look in terms of local currency when you expand the time horizon. This graph, the previous graph, is from 1790 to 1840. This graph is from 1790 to 2010. And now you see that those earlier long waves are dwarfed by the fact that prices never stop rising after 1940. And that leads many people to believe that, in fact, the idea of long waves is a dead letter, so to speak, because the main index of long waves, which is prices, no longer work. But if you instead follow Kondratiev's second method, which he did not graph, and one can understand in those days graphing was something more than clicking on an Excel sheet to see what the data looks like. So he did not graph it. Had he graphed that, he would have been able to point us towards something like this, which is my version of the Kondratiev argument, and that is the price of every country's producer price index translated into gold. That means something simple. I take the price of a basket of goods in the United States and I divide it by the price of gold, and that tells me how many gold ounces I need to buy that basket of goods. I'm going to come back, perhaps if I have time, to talk about why gold. But anyway, this is an interesting phenomena. And here you see these long waves once again. If you look in this graph, you'll see the first arrow points to the crisis of 1825, which is one of the great depressions in capitalist history. Then the second one, a kind of recovery, and then again a downturn, and where those next two red dots are is the crisis of 1847, the one that propelled two young men named Marx and Engels into the streets in the hope of overthrowing capitalism. And then again you see that long recovery that takes place until the Great Depression of 1873 to 1893. That's the first shaded part. Then the recovery again in the 1890s all the way up to 1929. And then the outbreak, all the way up to the 1920s. And then the outbreak of the Great Depression in the bottom part of the downturn from 1929 to 39. Then again, a great recovery that takes place till the late 1960s, and then the outbreak of the great crisis of stagflation that takes place from 67 to 82. Then once again, the great recovery that takes place in the boom period that I've been talking about. And then that downturn. As I said, I've been scaring my graduate students with this downturn since 2000. And you can see that beginning in 2000, the data starts to turn down, and our crisis in 2008 is very much on schedule, on Kondratiev schedule. I want to end by asking, well, why would it be the price of gold? And I do that because I don't want people to think there's something magical about gold. If I had time to show you the graphs of the price of gold and price indexes in general, you would see something quite striking, which is that before every crisis, the demand for gold rises very sharply. Not because you and I run out, or people like you and I run out to buy gold, but because, in fact, there's a reversion away from national currencies, from local currencies, national currencies, international currencies, to something which is not a currency, which is not validated by the performance of any one nation, but by the existence of circulation itself. And that, so far, the recourse for the capitalist class itself has been gold. And that rise in the price of gold causes the price of commodities expressed in gold to fall, and that's why you get that long wave. Let me conclude by saying that the argument I'm making should be a familiar one if you are familiar with the classical tradition, which is that this peculiar system, this system driven by profit, this system in which all other laws are subordinate to the laws of profit, has peculiar laws of motion. And it is that understanding that drove Adam Smith to talk about the invisible hand, that drove Ricardo to talk about the laws of political economy, and Marx to try to lay out the laws of motion of capitalism. Now, if that's the case, we have to ask ourselves, is this pattern of recurrence going to lead to an upturn? I believe it will. I believe that the upturn will come, and that it is an upturn for capital, but not necessarily an upturn for the populations of the world. It's not necessarily an upturn for the environment, but as several people pointed out in the question and answer session, so what? The whole point is that the system is not driven by what's necessary for people. It's not driven by what's necessary for the environment. It's driven by what's necessary for profit. So I believe we're in for a long period. Perhaps, if we're lucky, 10 or 12 years, because that would be a Japanese-style soft landing rather than a fall off the cliff as 1929. But if not, there will be a recovery, and the problems in the environment and of employment on a world scale will be acutely visible. One last point. We have not talked much, and I would like to be able to talk more about Brazil and the environment, but about population. Population control is one way to remove the problem for capital of an excess supply of labor. And we have not mentioned this at all, but I believe it's not accidental that there is such support for that issue in the capitalist system. If the growth potential of the system slows down, people become increasingly redundant, and redundant people are dangerous people. So one solution is to have less redundancy relative to the needs of capital. With that bleak message, I stop and thank you very much.